You've probably seen these three letters everywhere, right? ESG. They're all over the news, in company reports, and all over investment strategies. But let's be real, beyond the buzz, what does it actually mean for the bottom line? Today, we're going to unpack what might just be the most misunderstood and maybe the most important shift in modern investing. Okay, so let's just dive right in and get to the heart of the whole debate. This is the big question on everyone's mind. Is all this focus on environmental, social, and governance stuff just feel-good hype that actually hurts your profits? It's a totally fair question. And the answer, well, it's a lot more complex and honestly, way more fascinating than you might think. So just to make sure we're all on the same page, let's do a super quick breakdown. E is for environmental. Think a company's carbon footprint, how it manages resources. You get the idea. S is for social. This is the people stuff. Everything from labor standards in the supply chain to how they treat their customers. And G is for governance. That's basically the rulebook for how the company is run. We're talking board diversity, executive pay, and making sure nobody's up to anything shady. Now, if you're a little skeptical about ESG, you have every reason to be. And you know what? The skeptic's case doesn't start with some abstract philosophy. No, it starts with a very real, very messy problem, the data itself. Yeah, the data that's used for all this ESG analysis can be an absolute minefield. First off, there's no single rulebook, a total lack of standardization. That leads right to our second problem, inconsistent methods. It's like one company is measuring in miles, another in kilometers, and a third in, I don't know, football fields. On top of that, a lot of this reporting is totally voluntary, so it's often incomplete. But maybe the biggest headache for investors, trying to connect all this fuzzy data to what really matters, financial impact. Does this score actually tell me anything about the bottom line? It's often incredibly hard to tell. And this right here perfectly explains a huge bias in the system. Imagine a giant corporation. They can hire a whole team just to create a beautiful 200-page sustainability report. And because they have all this data available, boom, they get a higher ESG score. But then you have this smaller, super innovative company that might be doing amazing things, but just doesn't have the cash for that kind of reporting. So they end up with a lower score, not because they're performing badly, but because they didn't do as much paperwork. So you might be thinking, okay, fine, I'll just trust the big rating agencies. Well, that's a whole other can of worms. What's crazy is that one major agency, say MSCI, might give a company a stellar ESG score, but another one, like Sustainalytics, gives the same company a totally mediocre rating. Why? Because they're using different methods and weighing things differently. For an investor, it's like trying to find your way with two compasses pointing in opposite directions. It's chaos. But here's the thing. For all those totally legitimate problems with the data, the whole conversation is shifting. Because ignoring ESG isn't a safe bet anymore. In fact, it's becoming a really high-stakes gamble. Let's look at the staggering price companies are paying for getting this stuff wrong. $35 billion. Just let that sink in. That was roughly the bill for Volkswagen and fines and settlements after the whole Dieselgate emission scandal. And this wasn't just some environmental oopsie. This was a complete and catastrophic failure of governance. The decision to cheat, all for short-term gain, led to one of the biggest financial penalties in corporate history. And it's not just about cheating. Take a look at this. $30 billion. That's the estimated liability PG&E faced from the California wildfires that were linked back to its equipment. This wasn't a choice they made. This was a physical risk from the environment that was so massive it actually drove the company into bankruptcy. It just completely wiped out shareholder value. So the crucial point here is that these aren't just isolated horror stories. This table really connects the dots for us. You see, governance failures, they lead to massive fines and a total loss of trust. Physical risks, like crazy weather, that causes direct damage to your assets. And social risks, like the awful Rana Plaza factory collapse, that can cause immense financial and reputational damage. These risks are real, they absolutely impact the bottom line, and they are happening right now. Okay, so we've established the massive, terrifying downside of ignoring ESG. But the story doesn't just end with avoiding disaster. And this is where it gets really interesting. Can proactively managing ESG actually create financial value? Is there a real, tangible upside to all of this? The logic here is actually a pretty clear chain reaction. It all starts with strong ESG performance, as we just saw. That leads to reduced risk. Now, when a company is seen as less risky, both lenders and investors get a lot more comfortable. That directly leads to a lower cost of capital. And in the world of finance, a lower cost of capital, all else being equal, mathematically means a higher company valuation. It's a straight line from good practices to a better price. Let's break down that cost of capital piece a little more because it's so important. It really has two main parts. First, a high ESG rating makes investors see a company as safer, so they don't demand as high of a risk premium to own its stock. That lowers the cost of equity. At the exact same time, banks see less risk and are willing to offer better loan terms. That lowers the cost of debt. When you can lower both of those at the same time, that is a powerful financial advantage. And that brings us back to this idea of resilience. And look, this isn't just theory. Real-world studies, like those looking at the market crash during the COVID crisis, found that funds focused on high ESG companies tended to fall less and recover faster. They almost acted like a financial shock absorber, providing what investors call downside protection. It seems these companies are just built tougher for when the economy hits a rough patch. You know, what's really fascinating here is the importance of your time horizon. The financial perks of ESG aren't always going to show up in next week's stock price. But research from NYU's Stern School of Business found something incredible. Studies that took a long-term view were overwhelmingly more likely to find a positive financial like. This tells us that ESG isn't a short-term trading gimmick. It's a strategy for building long-term value. So how does all this value actually get created? I mean, it's not magic, right? It's about making the business fundamentally better. A focus on sustainability can fuel real innovation, as companies have to find smarter, cleaner ways to do things. It forces them to get way better at managing all kinds of risks. It drives efficiencies that actually cut costs. It helps them attract the best talent, people who want to work for companies they believe in, and of course, it builds a powerful brand that customers trust. These are the engines that turn good practices into great financial results. But before we wrap this all up, we have to talk about the final hurdle in this whole landscape. Because when there's real financial value on the line, there's also a growing incentive for companies to just look good on paper, whether or not the reality actually matches up. You've definitely heard of greenwashing, making misleading claims to seem way more eco-friendly than you are. But there are also its sneaky cousins. Greenhushing is when a company with terrible ESG performance just stays quiet, hoping no one will notice. And then there's greenwashing, where a company sets these huge, ambitious goals like being net zero by 2050, but has no concrete plan, no funding, and no realistic way to actually get there. All of this just destroys trust in the system. So, after looking at all of it, the skepticism, the risks, the rewards, here's the most crucial point. ESG has fundamentally evolved. What might have started as a simple ethical filter for some investors is now a sophisticated, essential framework for managing risk and spotting opportunities to create long-term value. It's moved from the fringes right into the mainstream of smart financial analysis. And that brings us to our final forward-looking question. When you see global regulations getting tighter and tighter, when you see investors digging deeper into this analysis, and when you see customers and employees demanding more from the companies they support, you have to ask, in the world we live in today, is the biggest risk of all simply failing to adapt? Is doing nothing the one gamble that businesses just can't afford to take anymore?